time for Yahoo Finance's Market Minute. Stocks rallying on the back of a Wall Street Journal report that the White House could cut some tariffs on China in half. Meantime, Tesla CEO Elon Musk letting investors know that he'll be scaling back his work at Doge starting in May. The excitement around his return offsetting Tesla's lackluster first quarter report, sending shares to the upside about 8% at the moment. Boeing shares also jumping after topping Wall Street's expectations in its first quarter. Boeing CEO is saying they're closely monitoring the ongoing trade war, and the company's massive order backlog gives Boeing flexibility in navigating the uncertainty. And the NFL teaming up with Adobe in a bid to bring in younger fans ahead of the 2025 draft on Thursday. Users will have access to NFL-themed templates in Adobe Express so they can create graphics to share across social media. That's your Yahoo Finance Market Minute. For more on what's trending on Yahoo Finance, scan the QR code. Track the best and worst performing stocks of the session.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and tricks that you need to grow your money. Hey, on today's show, investing in the gold trade. Is there still time to get in on one of the most crowded trades on the street? We discuss. And the Department of Education says student loan borrowers in default will have to start making repayments again. We bring on an expert who can break down your next moves. Plus, all week on Wealth, we're bringing you a guide to financial products. Everything that you need to know about opening different accounts, CDs, and debit and credit cards. Today, we focus in on investing in certificates of deposit, or CDs as they're known. You don't want to miss that. But prior to then, let's take a look at some of the market action. Beginning the show as we always do, 90 minutes into the trading day. Stocks, you see them rallying here today, looking to add to Tuesday's gains following reports that President Trump could ease tariffs on China. Joining me now, we've got David Miller, Catalyst Funds CIO and Senior Portfolio Manager. David, we got to know, how are you navigating market volatility right now?
Sure. So the way that we're positioning ourselves for market volatility right now is we're just positioning ourselves in companies that have tailwinds at their back, companies that have really strong moats, companies that have insider buying by their top executives, companies that have strong margins, companies that aren't permeable to things going on with the trade wars in the same type of way that you'd be concerned about like an importer or, say, an airline.
We were discussing with one investment officer earlier today who had said a lot of the rallies that we're seeing right now on the back of some of these interim moves, until we have full clarity around what the tariff picture looks like in the policy and negotiations, a lot of this has been being driven by retail investors. What does that tell you, especially amid an earnings season where we're already going to be hearing a lot, and so there are going to be a lot of cross currents perhaps that are needing to be digested by investors right now?
Yeah, to your point, what it tells you is that institutional investors like making decisions based on known information where they can make a decision that they can stick with for years or decades. Clearly what's going on right now is one response to what Trump is saying or one response to what China is saying after another, and they're going from one extreme to the next. So people don't quite know what to make of it, and that's why you're seeing such volatility in the market, and also such a pop back over the last couple days. One day he's threatening Jerome Powell's job. Next he's saying, no, I'm definitely not firing Jerome Powell. One day we're going hard after China and raising tariffs. Now we're cutting tariffs. There's just not a clear picture.
Could earnings season be a partial band-aid to some of those concerns for investors? And if so, what are the signs? What is the tone that investors should be listening in for on some of these calls, or even during the press releases after those roll out, and we get some indication on what the financial performance is looking like for businesses and their outlooks as well?
Frankly, I don't actually think this quarter matters that much, largely because the tariffs hadn't been fully baked into the quarter, first off. Second, the market's forward-looking. What it's really concerned about is what are tariffs going to look like? What is economic growth or contraction going to look like going forward? I mean, clearly tariffs are bad for the economy. They're bad for growth. They're bad for EPS. But the real question is what's going to happen on a go-forward basis. Like, obviously things were pretty bad in April of 2020. But people were given clarity once the Fed stepped in. And that's really what the markets are looking for now, is not the backward-looking what happened last quarter, but what is happening with trade policy and the economy on a go-forward basis.
You know, while we have you here, perhaps we can pull up gold just to see what that's doing, because last I checked in on that was seeing a 3% pullback here on the day. Now, let's remember, we had already seen some new, fresh all-time highs, and it's been a record run for the ages in gold here. And even as of right now, we're sitting at about 3,300 in gold. What does that tell you, even as we're continuing to hold on to this three-handle level, despite a reversal perhaps of, and not a full reversal, but this had really been piled into, in addition, off of the kind of fade America trade that had come forward, and everybody looking at this as the safest haven type of asset in gold. What is your own analysis that you're running around it?
My analysis is that what really matters with gold on a go-forward basis, certainly today, the good news that maybe we have a little more stability is what's actually hurting gold, but the much bigger picture is the fundamental dynamic for reserve assets has completely changed since 2022. And the tariffs have just exacerbated that, meaning that once Russia invaded Ukraine and the US weaponized the SWIFT banking system to seize $300 billion of Russia's dollar-denominated assets, if you're any other emerging market nation after that happened, you can't trust that the US wouldn't do the same thing to you if you do something that the US doesn't like. So if you're China and you own 750 billion of T-bills, would you feel more comfortable having 750 billion of gold bars sitting in a vault in Beijing that we couldn't take at the flip of a computer switch? So I think that's the really big mover, is these central banks, they bought over 1,000 metric tons of gold in 23, 1,060 in 24, and they've just pushed the pedal to the metal on that trade this year. And that's actually much bigger, I think, than what's going on the street or individual investor behavior for gold over the long term, is our central banks for BRICS nations or emerging market countries replacing their dollar reserves with gold reserves.
Beyond just buying gold outright and playing in the gold futures market, what are the other kind of multi-pronged ways for investors to add gold to their portfolio should they see an entry point that looks attractive for them?
Sure. Well, internally, for strategy shares, we run a fund that's called GOLY. It's the Gold Enhanced Yield ETF. It invests in a portfolio of investment-grade corporate bonds and does a gold overlay on top of that. So you get the price returns of gold futures plus the yield of investment-grade corporate bonds. But there's other ways to play it. So you can certainly go in the miners. The problem with the miners is they hadn't actually kept up with the price of gold, because gold miners don't really trade just off the price of gold. They trade off the margins for mining gold. And the problem is, as the price of gold went up, so did the costs in terms of labor, the cost of oil to mine gold, until this year when gold prices really started to take off more than the rate of inflation, when you really saw a rally in the miners. So I like a company called Franco-Nevada. It's ticker FNV. Because they don't actually run the mines, they get a royalty stream on the revenue from the mines. So they're not subject to those operating costs and capital expenditures that the miners are.
Really interesting. David, thanks so much for taking the time in studio with us.
Thanks for having me.
Now time for some of today's trending tickers. We're watching GE Vernova, AT&T, and Bitcoin. Joining me now, we've got my Morning Brief co-host, Madison Mills. First up, Maddie, we got to talk about shares of GE Vernova. They are rising after reaffirming its full year sales outlook between $36 and $37 billion here. Including in the guidance is the company's estimated impact from tariffs and subsequent inflation to the tune of $300 to $400 million. GE Vernova CEO touting the company's strong first quarter results and saying the company's well positioned at this point to navigate the current environment here. As of right now, we're continuing to track shares of GE Vernova. Of course, we're seeing those still hold on to gains right now of what looks like about 6%.
Yeah, interesting too, the company swinging back to profit as well, which of course is very important for investors. And this theme continuing on earnings calls of executives being able to convince investors that they have the unique ability to withstand any tariff uncertainty. And so far, that's been enough. But also to GE Vernova's credit, they got the fundamentals to back it up, reporting that first quarter profit of $264 million. That reverses a $106 million loss loss from the prior year and also exceeded analyst expectations. Revenue up by 11%, over $8 billion, surpassing the estimate of $7.5 billion. That was driven by strong orders in services and also orders in power equipment as well. And finally, the company's order backlog did increase by $4.4 billion, maintaining revenue guidance as well of $36 to $37 billion over the course of this next year, maintaining that outlook despite any impact from tariffs, which again, they say they're well positioned to handle.
All right, next up, we got to talk about AT&T. This company rising on strong customer gains here. Now, the carrier reporting it got more subscribers than analysts expected in the first quarter. That's 324,000 mobile phone customers versus Wall Street's projections for just a little under 254,000. I spoke with the company's CFO, Pascal Desroches, who tells me a few things here, and three main takeaways kind of came from that conversation. One of the main takeaways within that was just where this company sits in the demand for its services, regardless of what economic cycle we are. People love to scroll on their phones for cat videos and ultimately consume content on their social media feeds, connectivity for your businesses and whatnot. And so that really places some of the major wireless carriers at the center of that service that is continuously needed regardless of the economic cycle. He kind of leaned into that during our conversation. One of the other things that came up within our conversation as well was just how this company could be impacted by tariffs and what they're awaiting. They are awaiting more resolution, as many other companies are, but notably, they, of course, are working with the manufacturers of new phones and devices to try and understand how many of those devices are able to skirt tariffs by being shipped in ahead of some of the deadlines, and then on a longer term basis, trying to figure out what new models might be impacted as a result of tariffs. We're waiting for those negotiations. And just lastly here, Maddie, a $20 billion net kind of multi-year buyback rollout, that kind of buoying some of this investor sentiment that we could be seeing here on the day as well. I believe it's $3 billion of that's essentially going to kick off in the second quarter of this year. And then you have $7 billion that's going to take place in the rest of this year and into 2026. And then 2027, you've got $10 billion that they're going to initiate a program around as well. So watching more closely for that, but a lot at play within AT&T's numbers today.
And excellent that you were able to bring us that reporting, Brad, in terms of your conversations and getting that insight on the call as well. The only thing I would add is that there was a question mark heading into this print off the back of Verizon's disappointing earnings. AT&T able to eke past some of those concerns, but the wording from analysts slightly positive, appears solid, not necessarily super bullish there.
Absolutely. One of the other companies here, lastly, that we're watching, shares of crypto-related stocks here trading higher as Bitcoin holds above the $90,000 mark. This marks the third straight day of gains for Bitcoin. Crypto names including Coinbase, Strategy, Marathon Holdings or Merit Holdings, and Robinhood all getting a boost on that rally. You're seeing shares, well, not shares, but you're seeing Bitcoin higher right now by about 1.7% during this 24-hour period, we should note.
Right, and it's interesting because Bitcoin's been holding above that key 90,000 level, hitting that on Tuesday of this week and maintaining that momentum to the upside, bringing alongside the other crypto stocks with it. Are we seeing a bit of a bid into Bitcoin off the back of dollar weakness? Are we seeing a little bit of exhaustion in the gold trade, which is coming off its highs this morning? Investors seeking safety in some other alternative assets like Bitcoin and like Bitcoin-related stocks, which again are also continuing to move to the upside this morning.
Maddie, thanks so much.
Thanks, Brad.
Certainly. Everyone, you can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Coming up, new home sales surging during the month of March. We'll talk about what's behind the move after the break. New home sales surged 7.4% in March to an annualized rate of 724,000, according to the Census Bureau. That is significantly higher than the 1.3% increase that analysts expected. The beat largely driven by gains in the South, which rose to its fastest pace in nearly 4 years. Here with more analysis, we've got Lawrence Yun, Chief Economist at the National Association of Realtors. Lawrence, great to speak with you as always here. Just want to get your take, your analysis on what we're seeing play out in some of the data and whether or not it's sustainable.
Well, the new homes market, the newly constructed homes, is fairly smaller size compared to all home sales, generally about 10 to 15%. But the builders are putting up more smaller size home that is within the price points. And furthermore, the inventory availability 8 months supply. That is the metric that the housing industry analysts would be looking at. Well, generally, 4 to 5 months will be considered equal, but right now 8 months means builders have plentiful inventory. They're providing some incentive for the buyers to come into the market. So this gain, latest gain, is on top of the 2 consecutive annual gains in 2023 and 2024.
And so with that in mind, where are we seeing the most demand in terms of the buyer spectrum, if you will? Is it a lot of new first-time home buyers that are entering into the equation, or is this kind of new, or repeat, I should say, home buyers that are trying to kind of level up?
Right now, we have seen more of the existing homeowners who have seen sizable wealth gain by being homeowners, price appreciation, using that price appreciation to go into their next home. So the South region, we have seen the general trend of people from the northern states, or say from California, wanting to move to the southern state. So this trend is continuing. Moreover, if one looks at the employment data, all the job creation is principally happening in the southeastern states, along with Texas. Then you have Arizona and the Rocky Mountain states. So where there is a strong job growth, one should naturally anticipate that's where the potential housing demand is strongest, and it looks like it's being realized in the latest month.
You know, with this in mind, the administration, the Trump administration, has been laser focused on that 10-year and trying to pressure the Fed to take action in order for the 10-year to come lower, and that typically has some type of implication as well for the housing market, as that's most closely correlated to mortgage rates as well. What are you watching closely for how the Fed policy for the rest of this year could also be a direct corollary for the housing market?
You know, the Federal Reserve has indicated that will be on pause. But the mortgage rate is not a one-to-one relationship with the Federal Reserve. It's more related to the 10-year Treasury. So 10-year Treasury indicating the global bond market condition. If the people feel comfortable owning U.S.-backed government bond, then it makes the 10-year yields a little lower, makes the mortgage rates a little lower. So it will be a very welcoming thing to say to the global, and America is always provided the solid foundation, safest asset in the world. Furthermore, real estate, foreigners can come to the country, buy real estate, knowing that there would not be a confiscation of the property. So America has always enjoyed the global attraction, and the Treasury yield going down today, that is a very welcoming news, indicating that in times of uncertainty, people want to seek out either tangible asset in gold, perhaps real estate, or in the U.S. Treasury.
And while we have you, I wonder what you're making of the early innings of the spring home buying season and what that's spelling out for some of the forecasts that we had coming into the start of this year.
The existing home market is the larger market share. So in the existing home sales, the pending contracts has struggled through. Lack of inventory clearly hindering some of the activity. But as we saw in the builders data today, along with mortgage purchase application, that is to say, how many Americans are applying for mortgage to buy a home, and it is up 5% year to date. So there is a desire to get into the market. I think people are just looking for that right home to appear in the market. So as we see more inventory growth, we are seeing a little bit of growth in the existing home market, but I would like to see much more substantial growth and lower mortgage rate. That is the magical power to get the housing market moving. So once the 10-year Treasury mortgage rate comes down meaningfully, there could be a rush of buyers and sellers coming into the market.
Lawrence, great to see you as always. Thanks for the insights.
Thank you.
Coming up, we're breaking down the pros and cons of one of Warren Buffett's biggest investment tips. That's next when Wealth returns. Let's get a check of the markets, everyone. We are 2 hours into today's trading session here, and yeah, what you see right now is some big gains for the Dow Jones Industrial Average right now by about 1.9%. That equates to about 730 points. So off of some of the session highs, but still steadily holding on to gains here. And then additionally, you're taking a look at the NASDAQ composite, and I've put all of these in the context of a 3-day move just to let you know and give you some sight on how we've been trading over the course of this will they, won't they type of activity that's been playing out, transpiring in the markets for the better part of about 2 weeks now, and a little bit more than that actually. So as we're taking a look at the NASDAQ composite, and you can see the market reaction specifically on when we started to get news and get wind that there could be the conversations within the administration about what tariff policy and negotiations could look like in playing out, and the de-escalation here. So that certainly is something that's being received by the markets well here today. The NASDAQ composite, that's up by about 3.25%. S&P 500 up about 2.25% past 3 days. Net move higher about 2.4%. I also want to take a look at the heat maps here. Heard you love heat maps, so we've got some heat maps for you as long as the button works for me. We're just going to try and toggle this. There we go. So we know it works. In the meantime, let's get to our guest. Buy what you know. It's one of Warren Buffett's biggest pieces of advice for investors. He told Berkshire Hathaway shareholders way back in 1996 that they should invest in companies within their circle of competence. That is, businesses that they understand. By that logic, household names like Chipotle, PepsiCo, and Lululemon would be great fits for your portfolio potentially. Right or wrong? That's the question. Here to discuss, we've got Nick Yeomans, who is the Yeomans Consulting Group financial advisor and president. Nick, what are the pros to investing in names that you know, as Warren Buffett would say?
I think we start with familiarity, right? I mean, if it's a familiar brand, you can know it. Many of us know, touch, taste, from, you mentioned Chipotle or going even down to Home Depot every weekend. I mean, those are familiar brands, and you build loyalty and trust, and you kind of see what those consumer trends are when you're familiar with that brand. So those are the pros. I mean, you can really know the brand because you trust the brand.
And so what about the cons of using that as kind of your decision mechanism for which companies you want to invest in?
Yeah, and I think that's the most important part of this conversation is familiarity does not equal strength. Okay, just because we know a brand doesn't mean that we necessarily should trust that it's good investment. I can enjoy a company all day long. It doesn't mean I need to invest in that company. So we need to think forward, like today. What's the impact on from inflation? What's the impact from the tariffs talks? What are potential supply chain issues? I mean, we really have to think deeper beyond our loyalty and our trust in the brand, and we have to understand those fundamentals. It all comes back to the basics.
And so with that in mind, what are 3 things investors should keep in mind before purchasing a security, a stock?
Yeah, well, I think the first thing is, what's the financial health of the company? Going back to the basics. What does their balance sheet look like? What do the forecasts look like? What was the last quarter's profit call? I mean, we saw recently with Tesla. I mean, ouch, right? That really hurt. So we've got to think about what are the actual fundamentals? What do the financial statements look like? And we've got to get back to basics. I mean, fundamentals such as earnings per share. I mean, we kind of forget that when we start trusting and knowing a brand. I think the second thing is, what's the resilience? Going through the craziness of the market today, will this company be able to weather the storm? Will they come out on the other side brighter? I mean, I think there's a lot of great leaders of companies today, and you can't overlook that. What is the leadership of the company? And then, and a great example of that, Starbucks. I love what Starbucks is doing with the new leadership, and look at the changes. So I'm not necessarily promoting Starbucks by any means, but I am saying, they were willing to take on a new CEO, and I'm paying attention. And then the last thing is valuation. Do we understand the value today and what that potential value is going forward? Just because the company's down maybe 15 or 20% still doesn't mean it's a buying opportunity.
And so with that in mind, and you mentioned how investors should be evaluating earnings during a season of uncertainty like this, and uncertainty is the word that we're hearing from many company executives, early innings in this earnings season as it may be. We've still got some major tech companies. Next week is going to be a massive week, but this week it kind of continues the thread of what we heard to start off the earnings season from banks and Delta Airlines, most notably as well, with that uncertainty. How should investors be going about their checklist as they're listening in on some of the earnings calls and going through financials?
Well, I think we go back to Warren Buffett. If we don't know it, we can't understand it. We have no business investing in it. So be willing to pay attention. Okay, we've got to be willing to pay attention. Number one. Number two, we have to understand that for some investors, this could be a one swing at bat kind of situation where if you're willing to take a chance on a company or a brand because you know the brand, you trust the brand, and you believe in the brand, this could be a one swing strikeout. So I really like for retail investors today, and I'm going to pivot just a little bit and say, don't overlook the simplification of index buying today. I know Warren Buffett's a fan. Look at the Vanguard model. At the end of the day, I think owning a basket of stocks that could be undervalued with the brands that you know and you trust, you're not making a bet on one company, but you're really looking at a sector or an asset class. And I think that's the way to play the market for the average retail investor today. Pay attention, but don't overlook the index.
And finally, what are some easily understandable stocks that you believe are well positioned right now?
Well, my family and I would probably all agree. I've got 3 daughters, and my wife and I think Costco. I'm supporting Costco on a regular basis every weekend. Costco has such a tremendous business model, and I think that they're here to stay. They're going to weather the storm. They've got great leadership, and I see their market continuing to grow. Of course, they're going to be impacted by inflation and tariffs and price adjustments, just like everybody else, but they are locked on those corners, and they're not moving. Another company that we can't overlook is Amazon. I think Amazon, everything that they have their hands in today. I mean, I know outside of Costco, that's probably my number 2 place that I'm shopping on a regular basis. So talk about a brand you love, you trust. I continue to be, an advocate of Amazon and what their potential is. And I certainly think there's a big discount on them today. Don't overlook the grocery retailers. I mean, the Kroger company is a great example. In this market, it's easy to be a spec investor, but at the end of the day, people have to eat, and groceries are going to be a continuing necessity. I mean, we're going to shop every weekend, no matter what the tariff talks are, no matter what inflation is. I mean, we might pivot, what brand we're buying at the grocery store, but you're still going.
People got to eat. Nick, thanks so much for taking the time.
Yeah, thank you.
Coming up, more than 5 million student loan borrowers in default will be sent to collections in weeks. We'll tell you what to do if you're at risk. The Department of Education announced defaulted student loan borrowers will enter into collections on May 5th. Now, if you're one of the more than 5 million borrowers who are currently in default, you still got some options. We've got Mark Hantrowitz, who is a student loan expert and author, joining me now to break down what borrowers can do. Mark, good to see you again, and thanks for taking the time. If borrowers in default don't take any action, what exactly happens?
Well, a borrower in default can face what are called enforced collection methods. The first of them will be administrative wage garnishment, where 15% of their wages will be sent from their employer to the federal government. Then there's what are called Treasury offset programs, TOP, which include intercepting federal income tax refunds and offsetting up to 15% of Social Security, disability, and retirement benefit payments.
Now, defaulted borrowers, they've got kind of 3 main options to avoid those penalties. What are the pros and cons of each?
Okay, so they can rehabilitate their federal student loans, and there are 2 main methods of doing this. One is to make 9 out of 10 consecutive, full, voluntary, reasonable, and affordable payments through a loan rehabilitation agreement. The other is to consolidate their loans. Now, the pros and cons of these are consolidation is much quicker, but it doesn't remove the default from your credit history, whereas the other one does. And also, the interest and collection costs may be added to your loan balance, digging you into a deeper hole. Finally, borrowers who rehabilitate their loans through consolidation may be restricted to an income-driven repayment plan, which might be the right solution for them, but they will have no choice but to repay under an income-driven repayment plan.
For student borrowers who may not be in default yet, but are worried about their finances, what are some options for those with short-term financial challenges?
Well, if you're experiencing a short-term financial difficulty, such as medical or maternity paternity leave, or you lost your job, but you expect to get a new job soon, you might consider a deferment or forbearance. Deferments include the economic hardship deferment, the unemployment deferment, and the cancer deferment if you're being treated for cancer. And the main forbearance is the general forbearance. These suspend your repayment obligations while you fix your financial situation. They are short-term in duration, typically less than a year in duration and the maximum of 3 years. And interest will continue to accrue in in all forbearances and most deferments. And that means that the amount of your debt will increase. And as I said, that digs you into a deeper hole. So it's not a long-term solution, but it's reasonable solution for avoiding default if you just have a short-term financial challenge.
And so that's on the short-term side, but what can borrowers with long-term financial challenges do?
If you have a job, but it just doesn't pay well enough to repay your loans and you have no prospects for increasing your income, you should consider switching to a different repayment plan. Extended repayment and income-driven repayment have lower monthly payments than the standard 10-year repayment. They reduce your monthly payments by increasing the repayment term to 20 or 25 years. Now, that's going to increase the total cost of the loan because you're going to be paying interest for a longer period of time, but that's better than defaulting on it. Now, the income-driven repayment plans base your monthly payment on a percentage of your discretionary income as opposed to the amount you owe. And that may yield a much more affordable monthly payment.
You know, just lastly, while we have you here, Mark, as we think about kind of the Delta administration, over administration, and the change, I should say, that's taken place between administrations and the prioritization of alleviating some of these pressures for students while also making sure that funds are being paid back, what additional resources do borrowers need? What should be prioritized by the current administration?
Well, the borrowers need methods of reducing their debt, making the debt more affordable, options for getting information. So the call center is very important. They've had this AI assistant available called Aiden for a while. It mostly gives accurate information, but sometimes doesn't. The income-driven repayment plan application has been restored. That was on March 26, and they're going to start processing those forms in May, and that will get the borrowers who were in the SAVE repayment plan, 7.98 million borrowers, into another repayment plan. It's also important for borrowers to sign up for auto pay, which automatically transfers your monthly payment from your bank account to the loan servicer. Not only does that reduce your likelihood of defaulting on your debt or even being late on a payment, but you'll get an interest rate reduction, a 1/4 percentage point reduction in your interest rate, which is going to save you money.
Mark, thanks so much for taking the time here with us today. Really insightful information.
Thank you.
In a new survey from Debt.com, it finds 1 in 3 Americans say they rely on credit cards to make ends meet. 32% have maxed out their credit cards, 63% carry a credit card balance, and more than 1 in 5 owe over $10,000. All week on Wealth, heading into the second quarter of the year, we're helping you spring clean your finances, and today's focus is evaluating your debt strategies. Here to help is Nick Holman, who is the Director of Financial Planning at Betterment. Nick, good to have you here with us. Let me just get your thoughts on that survey and those findings and what it's ultimately saying about the state of Americans finding themselves in right now with regard to debt and credit cards.
Yeah, first off, thanks for having me back. The data's out, delinquencies are up, and there's over $1.2 trillion in credit card debt. We're seeing a lot of investors getting really nervous about investing in the stock market, and instead they're fleeing to cash. And what I would argue is many of those investors that are fleeing to cash would actually be better served if they take those funds and use them to pay down credit card debt instead of sitting in a cash account that might not be earning nearly as much interest as they're being charged on their credit cards.
How do you decide what kind of debt you should pay off right now and what strategy you should use?
Yeah, so I'm a math guy, I'm a numbers guy. I prefer what's called the debt avalanche, which if you're not familiar with it, it means that you prioritize paying off debt with the highest interest rate first. But we take it even a step further. So map out all of your debts, list out their interest rates. If you have any debt right now that has an interest rate above 8%, given where the market is, given where the Fed is, right now that 8% cutoff is what we're telling clients. If you have rates above 8%, pay that off before you do almost any investing.
So what about refinancing your debt? Is now a good time to do that?
For most clients, I'd say no. If you look at what the market's predicting, they're pricing in roughly 2 to 3 more rate cuts by the Fed before the end of the year. So if you're on the bubble about refinancing, I'd argue maybe sit tight. Hopefully those rates will come down 2 to 3 more times, even more than where they are right now. And that's when you should take the opportunity to refinance any high interest debt.
And so with what we were talking about in these survey findings, the number of Americans that are actually using credit, perhaps just as a bridge in order to make sure that they can get through some of the paycheck to paycheck pressures that they may be feeling, how can you ultimately, once you've started to pay down some of the debt, make sure that you're also setting up a better routine for not needing to tap credit as much?
Yeah, I saw just a headline recently where food delivery services are now offering buy now, pay later. So I think that really signals that some buyers out there are having a tough time making ends meet or living paycheck to paycheck. Sometimes it's not going to be some easy, simple answer, but taking a step back, prioritizing your goals, setting a budget that starts with your savings goals first, as opposed to what your spending goals are, that'll help make sure your priorities are aligned. And then tracking your funds on a monthly basis as well, using a budgeting app. You know, there's lots of these strategies that it's nothing necessarily new, but I would say coming into the new year, people are fresh off New Year's resolutions. Seasonality isn't really a thing with debt, but tax season is. And so if you're one of the 120 million taxpayers that's expected to get a tax refund, don't squander that influx in cash. Consider using that as a great way to jumpstart your new goals to pay down some of that credit card debt.
And while you're looking across your debt, how do you avoid some of the common pitfalls? And what are some of those frequent pitfalls that you've seen?
Yeah, I'm not anti-debt, just to be clear. I myself have like 10 credit cards. I love optimizing and getting as much value and points as you can. But we see a lot of clients really get tripped up on that. So if you are starting to go into the credit card game and trying to maximize points and miles and those types of things, one thing that you need to make sure of is look at credit cards that have a downgrade path, or sometimes it's called a product change. Google that term if you're thinking about applying for a card. What that means is you can sign up for the card, take advantage of any sign-up bonuses or great rewards that they have, but it gives you an exit path. So if that card, for whatever reason, no longer makes sense or you can't justify the high annual fee that it has, you can downgrade or do a product change to maybe a lower fee or even a no-fee credit card. And that's going to make sure that you're not living for the short-term points and sacrificing your long-term financial future.
My thanks again to Betterment's Nick Holman. Coming up, your guide to financial products. We run through certificates of deposit and whether or not they belong in your portfolio. Stay tuned. Markets have been volatile in the last month as investors navigate changing tariff policies. So, are there less risky ways to grow your money? Of course, one option is a certificate of deposit, also known as a CD. CDs allow you to save money in an account, while the bank pays you a fixed rate as long as you hold the money for an agreed period of time. But there are upsides and downsides to using a CD. Here with everything that you need to know, we've got Stephen Cates, Bankrate financial analyst. Good to have you here with us, Stephen. So let's just dive into this and some of the details that people need to know about CDs. First, let's just kind of define the length of time that correlates to the return. What typically is that?
Well, CDs can range from a variety of maturities from as short as 1 month, typically out to 5 years. I think the most common kinds that people are going to get are going to be somewhere between 6 months, 1 year, out to that 5-year range. Very, very short-term CDs like 1 month are more rare.
And so why a CD versus perhaps a high-yield savings account?
Well, high-yield savings accounts are going to be very susceptible to interest rate changes. Now, that's great when interest rates are going up, but we're all expecting at some point that interest rates are going to start to fall again. And if you are in a longer-term CD, you have now a guaranteed rate of interest over that term, whereas high-yield savings accounts, they are going to fall almost immediately as those rates drop.
And so with that in mind, what about CD versus a bond, for instance? Because some people may say, well, hey, what you're describing with the CD sounds somewhat similar to a bond. Can you break that down?
Yeah, so CDs are FDIC insured from a bank, which is certainly a satisfying sort of addition to have. And I think people feel good about feeling like they have that kind of explicit guarantee from the government. Now, you could look at something like a treasury bond, again, which has an explicit guarantee from the federal government. But one of the big differences is going to be that bonds are going to be priced constantly. Now, if you hold both to maturity, you're going to get what you're promised. On the same 1-year treasury or 1-year CD, you're going to get the interest rate that you expect, and you're going to get your money back at the end. But with a bond, you may start to notice that the value of that bond is going to change throughout the time that you own it. That can be a little bit unsettling for certain people, certainly in an environment like today where interest rates are moving quite rapidly up and down. That might be something that people simply don't want to deal with, in which case a CD could be another good option. And if you shop around, you may be able to get a higher rate.
Here's something that I was excited to have you define for us. Just what is a CD ladder here, and when do you use it?
So CD ladders are great, and I actually really love them. Bond ladders similarly, but so any kind of laddering product. But it's a wonderful way to balance sort of liquidity needs and higher interest rate guarantees over time. So the way that you might structure something like that is that you take some of your money and you buy different maturities. So possibly 1, 2, 3, 4, and 5-year CDs. Instead of buying simply 1 year or 5 year and putting all your money into it, you'd put a little bit of money into multiple maturities. And that means that every year you're going to get another piece of your money back to reinvest. And it can balance your need for having a little bit of access to your money over time and not being committed to a long-term CD, but still getting a higher average interest rate than you'd get if you parked it all in a shorter-term CD.
Bankrate financial analyst Stephen Cates, thanks for taking the time.
My pleasure. Have a good day.
You too. The Federal Reserve is expected to continue its rate-cutting path at some point this year, which could affect rates on savings accounts and CDs, but they haven't started yet, and many people are still getting an over 4% return on their money. Our very own Casey Bond joins us with the top rates available right now. Casey, what have you found?
Right. So by historical standards, CD rates are still quite high. And we're seeing right now that the best rates are ranging between about 4 to 4.5%. And that's on terms of around 6 months to 18 months.
So how do you choose the right account and term for yourself?
Right. So it's very important to make sure you choose a CD that matches your savings timeline. You want to select a term that's long enough to get a good rate, but not so long that you're stuck without your money and may need to pay an early withdrawal penalty if you do need to pull it out before the maturity date. Another important factor to look at is the minimum opening deposit. That's the minimum amount of money you need in order to open an account. So some CDs may only require $100, while others might need $5,000 or more.
So what do you do once the CD matures?
you have a few options. One of the best things you can do is take that time to reevaluate the current interest rate environment. You might find that there are other CDs offering better rates at that time, or you may find that interest rates are still on the decline and you want to roll those funds into a new CD at a higher rate and lock in that rate before rates drop again. Another situation you may find is that you need more liquidity and a CD no longer makes sense. So you could move those funds to a high yield savings account or some other savings or investment product that just makes more sense for you at that time.
Casey, thanks so much for breaking this down for us. Really appreciate it.
Thanks again for having me.
Certainly. Treasury Secretary Scott Bessent says tariffs between the U.S. and China need to come down before talks can begin between the countries' economies. Bessent making the remarks to reporters after a keynote speech at an Institute of International Finance event in Washington, D.C. He said, quote, "Neither side believes that these are sustainable levels," and, quote, "This is the equivalent of an embargo, and a break between the two countries in trade does not suit anyone's interests." Bessent did bat down a report that the Trump administration is considering slashing steep tariffs on Chinese imports, with some by more than half, and may even be considering a tiered approach. He says that there's been no unilateral offer from President Trump to de-escalate. Bessent also said a full deal with China might take 2 to 3 years. In terms of deals with other trading partners, Bessent said the U.S. is, quote, "very close to a trade deal with India and are proceeding with other trading partners." Shares and major averages we've seen rising on a lot of these movements here. As of right now, major averages holding on to gains across the Dow, the S&P 500, and the NASDAQ. On a sector basis, we are still largely positive, being led by consumer discretionary and technology, while consumer staples and energy lag. Taking a look at these markets as we've continued to really move throughout the earnings season as well. We've got some major reports that are still yet to come over the course of this week and into next week. We'll continue to bring those your way. As for right now, that's it for Wealth. I'm Brad Smith. Thank you for watching. You can stay tuned for Market Domination with Julie Hyman and Josh Lipton. That comes up at 3 p.m. Eastern Time, and they'll count you down to and through the market close. You don't want to miss it.